Hello, good morning and good afternoon to all the participants. I do see that the participants are still joining us. As we are on top of the hour, we'd like to get started with the session. For today's masterclass, our topic is digital world-class performance of order-to-cash shared services. And As part of our masterclass, we have a masterclass speaker, John Salick. He's the strategic advisor and subject matter expert at Emagia. As we progress into the masterclass, I would like to request all of you to please keep yourselves muted as we go along with the session. But if you do come across any questions, you can post your questions in the chat window. We will take those questions at the end of the session. With this, I'd like to now invite John to begin the session. John, over to you.
All right, Akshay, thank you very much. I have another good program for you today. And I'm glad we're talking about the topic of shared service organizations. They have a tough mission, which we'll get into in a little bit. And certainly any ability to improve their performance is certainly welcome by not only the leaders of a shared service organization and its team members, but also its customers, internal and external. So we'll start out with a kind of an introduction, and then we'll get into what those delivery challenges are for shared service organizations, and they are significant. We'll share with you some world-class performance benchmarks, and we'll talk about the capabilities required to achieve or approach achieving those benchmarks. Share with you actually a couple case studies, recap the benefits, wrap it up with a conclusion, and then take any questions that you have. Okay, introduction. You know, why have shared service organizations? Why were they created 25, 30 years ago? Well, the theory is they can provide back office services better and cheaper than they can be performed in a decentralized environment. And I think that's proven to be true. I think the fact that they're still in existence and have mostly grown and been adopted by most companies of any size um, is proof of that. I mean, there are even global shared service centers where one center will handle all of a company's back office business across the globe, dealing with the languages and currencies and things like that. More typically, what we've seen is a shared service organization for the Americas, one for Asia, and one for Europe, Middle East, Africa, that type of thing. So that's their purpose. And the performance demanded is rigorous. You know, everybody's a customer, everybody's a critic. And so there's tough performance requirements, which are closely measured and monitored. And for third parties like outsourcers, their sustained inability to meet performance requirements known as service level agreements, SLAs, result in fines or a reduction of the fees they charge or the fees they get paid. And you know, so what's the secret? Well, there's no secret, right? It's process, people, technology, metrics are the key elements to meeting this very demanding environment. Let's look a little more closely at what those challenges are. The first one is what I call an existential challenge. um, and I think it's fading now as companies get used to it. It's just kind of the way it is. But a decentralized organization, and in my experience, a number of them did not like to give up operations and the control of having an O2C operation under their direct line of authority. And so there's a little bias there. Believe it or not, had one client where a division president claimed that he could not be held totally responsible for the revenue, profit, and cash generated by his division unless they had cash application in-house under his division's direct control. Cash application, really? That's one a little hard to believe. And, this was before the legalization of marijuana, so I can't explain it. So you've got this bias there within the company. And then the other major challenge is what I call the unrelenting cost pressure. Let's say last year, 2020, you reduce the overall cost of your shared service operation by 4%, and you get praise, good job. Even in the pandemic and remote work, you're still able to reduce costs by 4%. That was great. But this is 2021. What are you going to do for us this year? Another 4%, maybe 5, 6? So there's always that pressure. And then, as I mentioned earlier, the service level agreements, pretty strict. And here again, they tend to escalate every year. So let's say a company's DSO was 47 when the shared service operation was created. And then last year you brought it down to 45. Well, when planning for the year ahead, everyone's going to say, well, how about DSO of 43 or 42 next year? So there's, again, unrelenting pressure to improve the performance year after year. And these SLAs and these measures of performance can be very detailed and closely monitored and measured. And of course, shortfalls will be punished one way or another. Some of the other challenges is SSO has to accommodate all divisions and business models. So, if it's businesses where you make a product or distribute a product, where you pack it in a box and ship it, that's one business model. But then let's say you've got services, you've got a subscription-based model, a monthly charge for providing a service. That's a different O2C challenge in terms of billing, collection, cash application, and things like that. So an SSO has to accommodate all these different business models, and of course in economies all around the globe. And then certainly, since an SSO does deliver cost efficiency and other benefits, the corporate interest is to onboard new divisions into the SSO as quickly as possible. So there tends to be a flow of new divisions in, and of course, everyone wants that to be up and running and at peak efficiency in 2 to 3 months, which is not always possible, but another big challenge. And then overriding everything is the need to deliver an excellent customer experience, both for the external customers and for the internal customers. And certainly in the last 18 months, a dire need to accommodate work from home. So we just talked about 6 serious challenges to SSO. Not an easy task, not an easy job. So we look at those challenges. Now, let's try to quantify some of the performance benchmarks. And for this, we rely on Hackett. And I chose just a few benchmarks for common O2C functions at a shared service operation. Credit vetting, deciding what credit limit to assign to a potential new customer. The world-class benchmark is 2 days, which is fast, but it's also beneficial because it enables you to establish a credit limit and perhaps preempt other suppliers. How about collections? Average days delinquent, that is the actual DSO compared to the best possible or terms weighted DSO, is 4 days beyond terms. I mean, that's also very good performance. The beauty of that measure is it's not affected by granting extended terms. And a 4-day gap is actually very good because remember, for those of your customers who are still paying by paper check that gets mailed via the Postal Service, most of the time those checks will be mailed on the due date and then depend on the mail service to get them there. So you've already got 2-3 days built in there. Auto cash hit rate on Cash App, 75%. So 3/4 of all the payments coming get automatically applied. That's great. Now, we've seen auto cash hit rates 90 and even slightly above 90%. But when you think of a shared service organization dealing with different divisions, different business models, different customers, different currencies, languages, banking systems on a global basis, 75% on a global basis is actually not bad. Resolution cycle time for deductions, 7 days. So from the date that deduction is created to when it's cleared from the AR legend, 7 days. That's good. That's quick. And major benefit there is for invalid deductions. The faster you charge them back to your customers, the higher the likelihood you'll get paid. If you're pursuing a deduction that was incurred 4 months ago that you just got around to researching and resolving and determining that the customer was wrong, it's 4 months old, your success rate's going to be pretty low. But if you're turning it around in 7 days, that enhances your probability of collection. And then the last one, which is a tough one, and this is a real impressive benchmark. The entire cost of your credit to cash process, people, salary, benefits, IT costs, supplies, et cetera, 0.04% of revenue, not 0.4, 0.04. Extremely low, extremely efficient. So these are world-class benchmarks. Pretty impressive. How do you get there? Or how do you at least get close? So what are those capabilities required to achieve this kind of performance? Well, as I mentioned earlier, it's a mix. One of the key ones is policy, and let's just spend a minute on that. Certainly documented policies with clear exception protocols, but also what I call work reduction policies. And let me give you an example. When you think about deductions for shortages of product or damage to product, there's generally a high quantity of those, and they tend to be lower dollar amounts, lower values. But if you're gonna, research and resolve most of them, that's an awful lot of work, especially since they're virtually not collectible, unless it's a real grievous deduction. One policy that gets around it is you go to a customer and say, hey, we looked at the last 2 years of data, and over those 2 years, you had shortage and damage claims of 0.3% of sales. So why don't we do this? On every invoice, we'll give you a 0.3% discount. And in return, you don't take any more of these shortage and damage deductions. Keep them with you. We don't want to see them. That can result in a substantial reduction in volume of deductions and work. What are the capabilities? Well, process, best practice, right? Everyone's got their best practice. Needs to be adapted to the businesses served. The right metrics. I'm a big believer in fewer rather than too many. Analytics, very important. It gives you insight into problem areas and opportunities for improvement. And of course, the right governance, which is, one word, easy to say, gets a little tricky with a shared service organization. And these are the elements that provide the foundation. But, and it's a big but, if you hope to get even close to that Hackett benchmark on cost, you need automation. And you need it to make a big impact. hence the phrase hyperautomation. And the way we define hyperautomation is it's the confluence of three technologies: intelligent document processing, robotic process automation, and AI-powered digital assistants. And of course, all working with and integrated with your ERP, and it can automate 70 to 90% of transactions in an operation, like Cash App. So if there's an operation that has a high volume of transaction and is performed manually, you can get huge increases in productivity with hyperautomation. And remember, that cost reduction target advances every year. And the other contribution hyperautomation makes, is it improves accuracy. And of course, that eliminates rework. And, some errors take a long time and a lot of work to correct. Here's a schematic on how it works. And you all get a copy of this PowerPoint so you can read the details. But just kind of follow the major flow here, kind of like a factory floor. The far left is all the incoming information, documents, requests that your order to cash operation has to process and deal with. And it comes from customers. It comes from banks. It comes from credit bureaus. It comes from other external sources, all in different formats, lots of it unstructured. And it can come from vendor portals, your own EIPP portal. We're talking about Excel files, PDFs, talking about paper documents, lockbox data, EDI transmissions. I mean, just a whole agglomeration of things, which is kind of how I listed them there. So that's the incoming. Where does it go? Well, the first step is the intelligent document processing, IDP. And basically what IDP does is it extracts the required data and converts it from an unstructured format into a structured data file, typically a CVS file. Now, this is a prerequisite for RPA. RPA can't handle unstructured data. So if you want to take advantage of RPA, and you should, you need IDP first. And again, that can automate 90+% of this data extraction and putting it into a file. I have visions of inputting it into a file if done manually. So that's the first step. And then that file processed through RPA or more advanced capability digital assistant. The RPA accepts the data, conducts the basic processing with the ERP. I always look at it as RPA emulates the human interaction with an ERP system, inputting data, driving operations. Its cousin, AI-powered digital assistance, takes much broader, much deeper, much more empowered roles. For example, it can retrieve credit information. It can calculate a credit score, recommend a credit limit, conduct collection dialogue via email, not just a dumb done letter or done email. It can respond to replies from a customer. And of course, auto cash, routing deductions, a host of operations. Here again, you have an opportunity for operations that are totally manual to automate 70 to 90% of them. I mean, huge jumps. And then once it leaves the RPA or the digital assistant, the transaction is either done and closed and is recorded in the GL, or there may be further processing required. But these steps here account for a lot of work and potentially a lot of savings. So let's just look quickly at a few common order to cash processes and where HyperAutomation helps. Let's talk about credit risk management. Well, first of all, you can design an online credit app customized to what you think are the important factors affecting your credit decision. And the applicant fills it out, has a digital signature, and submits it online. The digital assistant can retrieve the credit bureau information from D&B or Experian, check trade references, bank information, check the OFAC list, confirm business license, sales tax identification number, stuff like that. Do all that automated. And then, again, with parameters that you specify, it can do a credit score and also convert that into a recommended credit limit, send it out via workflow according to your approval DOA policy, and of course also involves a key part of credit is the automatic order hold, which in some companies the automatic order hold is their credit policy and is their collection prioritization strategy. So a lot can be automated in credit. Let's look at collections. Collections a little tougher because it involves interaction, and but you can send out, I would call, intelligent dunning emails. First of all, for your collectors, you can configure the collection strategy, generate a task list and a workbench to fully equip the collectors. But then it can conduct that, what I call, interactive dunning for your smaller accounts that ordinarily wouldn't be touched with a phone call and probably being not touched or sent kind of a inert dunning email. This email says, customer, you've got 5 invoices over 7 days past due. Can you pay those today? Customer replies, no. So then it responds. It interacts with the customer. Can you pay tomorrow? No. Can you pay by the end of the week? No. Now, if any of these responses are yes, then the digital assistant sets up a promise to pay with a follow-up date in your collection system. So it doesn't just lie there in an inbox. It can interact. Now, it can still be ignored, but again, if you think of the hundreds, thousands of small customers that your collectors never get to, clearly a nice tool here. Cash App, HyperAutomation does it all. The IDP extracts the data, puts it in the right format. The AutoCash engine, which can be customized and learns, takes advantage of machine learning, natural language processing, those technologies. We're seeing, 85, 90% hit rates. I mean, very impressive. Creates the deductions and can also automatically execute the write-offs and match debits to credits. And finally, with deduction resolution, it can create the deduction. For customers with a vendor portal, it can find out the reason code and attach it to the deduction, which in many cases is the determinant of where that deduction gets routed for research and resolution. Full-featured workflow, match the credits and debits, clear them, and also most HyperAutomation capabilities come with very capable analytics packages to help you identify and quantify the major sources of error and the benefits of correcting that. Okay, so you can see a lot, right? You can see a lot here of all right. You can see a lot of capability here with the HyperAutomation. Quick case study, American Heart Association. Big problem was new customers, it was taking 2 weeks to approve or disapprove their credit application. So what did they do? They deployed these HyperAutomation capabilities from Emagia in the credit solution. And the result was the cycle time for credit app approval went from 14 days to 1 to 2 days, which meets the Hackett world-class performance benchmark. I mean, what a great improvement. Another one, a global medical product supplier. Now, this was a big company with a high level of complexity. They had SAP, they were operating in 30 countries with all the diversity in language, in banking systems, in currencies. So it was a pretty complex environment. They implemented a number of these O2C hyperautomation capabilities, took the deduction resolution cycle to 5 days. Great. Remember, the Hackett benchmark was 7. Auto cash hit rate on a global basis went from 50 to 80%. Huge, huge increase. And with the touchless collections, we're able to reduce the DSO by 7%, mostly among the small and medium-sized accounts. So the benefits, I've been mentioning them as we go here. Really does help you provide an enhanced customer experience. One, to the external customers with the improved speed and accuracy of your processing, but also to your internal customers. Tremendous cost savings, a variety of sources, not only staff costs, but also in bad debt and funding of AR. And so, what does it drive? Higher revenue, lower cost, better cash flow, happier customers, and over time, that's going to lead to success defined as increased revenue and profit. So, a couple minutes left here. What's our conclusion? Well, first is the recognition that shared service operations really face an unrelenting demand for excellence and to improve it every year. And while there are many factors that influence the ability to meet those demands, at this point, it's technology, it's automation is going to be the biggest driver of improvement, and specifically the hyper automation capabilities we just described are essential. Your questions.
Thank you, John. Let's get started with the Q&A here. The first question is, what are the most important challenges of a shared service center?
Well, it's serving many masters, but it's delivering cost efficiency and an improvement in that cost every year. It's ability to cope with various business models and the challenge of onboarding new divisions, never to be underestimated.
All right, John, thank you. The next question that we have is, what is an example of a policy that reduces work?
Well, I mentioned the allowance for shortage and damage deductions. Another one that I've seen work very well is what I refer to as the automatic small balance write-off for deductions. So if you get a deduction for $2, do you really want to set that up and route it to somebody for research and resolution? No, just write it off, be done with it. I don't think anybody would argue with that. But you can extend that argument to actually much higher values. Because remember, 95% of deductions the customers write, so you're not going to recover any money from them. So we had one client that actually raised that automatic small balance write-off to $600, 600. And what it did was it reduced the number of deductions that they had to process by 42%, almost cut them in half, at the sacrifice of value of only 2% of the value of total deduction value, only 2%. And remember, 95% of that 2% is not going to be collected anyway or invalid anyway. So for a very small opportunity cost, you're cutting volume almost in half.
Thank you, John. We are almost on top of the hour. Let's say the last question here. The Hackett benchmark for credit rating is 2 days of elapsed time. Is this realistic?
It is. It is if you can automate and accelerate the securing of the data you need to make a credit decision. And the other nice thing about an online credit app is it won't be accepted and the clock won't start ticking until the potential customer has completely filled out the credit app. So you avoid this back and forth. Oh, you didn't fill out rows 7, 12, and 18. Send it back and forth. No, none of that happens. If the customer doesn't fill out rows 7, 12, and 19, they can't submit the credit app. So that really shrinks the cycle nicely.
Thank you very much, John. I think we are on the top of the hour. It's time to wrap up our session. And I would like to thank you, all the participants, for joining us. And also want to take the opportunity to invite you all for our next session, Reducing Complexity of Cash Application in Europe with AI. This is going to be on 23rd of September at 10 a.m. Pacific time. So look forward to seeing you all there. If you have any questions, reach out or write to us at info@emagia.com. We'll be more than happy to respond to your questions. Thank you all, and thank you very much, John.
Thank you, Akshay. And yes, please, we love to get questions, so don't hesitate, even if it's a week or a month from now. Thank you, everyone.
Thank you.